Good morning. I am Lisa Abbott, Executive Vice President of Economic and Community Development for Regional Opportunity Initiatives, and I would like to welcome you to our fifth of our six-part webinar series based on the Indiana Uplands Regional Housing Study. We are very excited to have you join us this morning. Last session, we began our exploration of housing tools with the IU Center for Rural Engagement Hoosier Housing Toolkit, and today we will continue with a discussion on housing development finance. We would like to encourage you to ask questions. Please put them in the chat and we will ask them of our panelists at the end of the presentation. We would like to invite you to enjoy our last session of this series on housing quality. For more information, you can go to our website to register at regionalopportunityinc.org. If you've missed our past sessions, the recordings are posted on our website. So now I would like to introduce our speakers for today. Up first is Steve LaMotte Jr. He is an Executive Vice President and co-leads the Indianapolis-Louisville multifamily within CBRE. Since joining CBRE in 1994, Steve has focused exclusively on the sale of apartment properties throughout the central U.S. Over the last 10 years, Steve and his team have led production in their markets on large institutional grade, high-profile assignments. His team is the overwhelming leader with $1.1 billion in volume in the Class A space since 2012. He is routinely included among CBRE's top 10% of investment property producers nationally and is consistently the top producer in CBRE's Indianapolis office. Steve sits on the advisory board to the IU Kelley School of Business Center for Real Estate Studies and the Apartment Life Midwest Advisory Board, and has also served on the board of directors for the Indiana Commercial Board of Realtors. We will also be hearing today from Eric Baird. He is the Senior Vice President, Chief Lending Officer at Owen County State Bank, based at their Highway 46 and Arlington Road branch in Bloomington. He has a diverse background with 25 plus years of C&I and commercial real estate lending experience in multiple areas, including credit, underwriting, lending, and management. Growing up in Salem, Indiana, he moved to Central Florida in the late 80s to work in his family's mobile home business after working towards a major in economics at IU Bloomington. His banking career began with Barnett Bank in 1993, and through various acquisitions took him to Los Angeles, California in 1999. After 12 years of working in various positions with large money center banks to small community banks, he decided to move back to central southern Indiana, closer to family, to complete his remaining years in this field. He lives in Columbus and is active in the community, participating on various committees and boards. When he is not at the office or visiting clients and projects, Eric enjoys activities with his family, as well as playing guitar, participating in CrossFit training 3 days a week, and riding his motorcycle as time and weather permits. And last, we will be hearing from Brian Payne. He serves as the Executive Director of CDFI Friendly Bloomington, an innovative new organization to increase access to flexible, affordable financing for community development. CDFI Friendly Bloomington helps community development finance institutions invest in affordable and workforce housing, small business growth, and new community facilities in Bloomington, Monroe County, and Southwest Central Indiana. Prior to his current role, Payne served as Assistant Director of the Economic and Sustainable Development Department for the City of Bloomington. In that capacity, he worked on priority economic development projects for the city, negotiated tax incentives, and supported a broad range of small business and entrepreneurship activities. Payne came to Bloomington from the federal government, most recently as policy advisor and legislative affairs for the Department of Health and Human Services in the Obama administration. Prior to that, Payne worked on Capitol Hill as a legislative counsel to 2 members of Congress. He earned his Juris Doctorate degree from the University of North Carolina School of Law and a bachelor's degree in English and philosophy from Lawrence University. Before attending law school, he worked as a teacher, social worker, and a high school athletics coach. So welcome, all of you. Again, I would like to ask all of the participants in today's session to please put your questions in the chat and we will address them at the end of the presentation. Oh, before we do that, I want to announce our first poll. We would like to know how familiar you are with the financing process. So please take a minute to fill out our poll, and we will announce the results at the end of our presentation today. Okay, I would like to turn the screen over to Steve. Take it away.
Well, good morning. It's a pleasure to be here speaking with you this morning. Thank you for the opportunity to share some thoughts that we have on the financing of development, in particular multifamily. As was mentioned earlier, I work in the apartment space and exclusively. I've spent my career in that space and transact multifamily property throughout many of the markets in the central Midwest, particularly Indianapolis, where I am based. And so I'm going to chat with you about some of the things that I'm seeing in the space today, as it relates to a number of different factors in the apartment space and the financing of multifamily and investor demand and so forth. But to start, I will just open by saying the obvious, that it is a phenomenal environment that we find ourselves in the apartment space. In 2020, we're entering the 11th year of this long run in expansion in the apartment space in terms of development, the capital markets, the acquisition market, investor demand, and the renter demand for multifamily. It's unlike anything that we've ever seen in the history of the apartment industry, frankly. And the shift that we have all witnessed over the last 10 years from owning housing to renting housing is profound. And that has been, that's been the fuel that we have, we've seen in propelling the apartment market to the place where it is today. So, those of us in the market would expect those trends to continue. We don't think there's ever going to be a return to the kind of demand that we saw for single family as a strong preference over multifamily, like we've seen in prior environments. And so that, and for that reason, and a lot of other reasons, those of us that are in the apartment space are very bullish about what the future looks like in this space for the indefinite future. I would perhaps even say for as long as any of us plan to be in the business. I think there's a permanent shift to multifamily. And the reasons are self-evident, but just to state some of the obvious ones, when you're in an apartment, you, particularly a newer property, you get a set of interior apartment kitchen features that are just not generally available for the same price point in the single family space. You get oftentimes amenities that are resort level or quasi resort level that are obviously not available in single family housing. And perhaps most importantly, you get proximity to amenities, to employment, to features that people now are able to walk to. And typically in owner occupied or single family housing, you're not getting access to those same features at the same level. You can't just walk downstairs or walk across the street to your favorite restaurant or walk 5 blocks to your job, oftentimes when you're in single family housing or in owner occupied housing. But you get those features increasingly in the apartment space. And so those features become very addictive, and the renting public becomes attached to those features. And so what we see is the amount of time that a resident stays in an apartment is significantly longer today than it was at any point in the past. Typically, apartments were a launch pad into single family, and today it's not so much a launch pad; it's a lifestyle choice. The other shift that we've seen is to the urban environment, and again, pointing back to the locational features that I just mentioned. The resident wants to be able to walk to fill in the blank, any number of amenities, features, entertainment, dining, work, church, all these things that are in closer proximity typically to multifamily housing than single family housing. So we've seen this shift to the urban cores. Now via COVID, we've seen a little bit of pushback from that. So I think the jury is still out on what the renter public prefers urban versus suburban in the long term, but certainly over the last 6 or 7 months, there's been a little bit of a reverting back to suburban preferences. But I think what's most interesting about COVID in the apartment space is that the rent collection train wreck that many forecast in the space just didn't happen. Apartment properties are still collecting rents. NMHC, which is the National Multi-Housing Council, National Apartment Organization, is tracking collections kind of on a week-by-week basis through the crisis. And I can recall earlier in the COVID crisis, seeing several 2 or 3 months where at various points collections were actually higher in 2020 than they were in 2019. And to think that we could possibly be collecting rent better in a global pandemic than in normal times, i.e. 2019, is pretty remarkable. And it's just a testament to the strength in the apartment space. So overall, things are well in this sector. And we're going to talk just a little bit about what we're seeing. Before I dive into the slides, I wanted to touch on just a couple other points. And one of those is the risk associated with developing multifamily. It's a phenomenal sector for sure, but anytime a developer is deploying millions of dollars of cash in the form of equity investment and pursuit costs and entitlement costs to go build a multifamily community, and is typically signing personally for that loan, there's significant risk in that. And I've got clients who probably at any given point in time have several hundred million to perhaps $500 million of contingent liabilities hanging over their head in construction loans and 8, 10, 12 different projects at various points before they can get off of that construction loan and onto permanent financing, which is non-recourse. But to be able to go to bed at night with that kind of liability hanging over your head requires a special personality and a special risk tolerance, which is why we have developers who are capable, comfortable, willing to take those risks. But even in good times like this, it certainly doesn't come without risk. And particularly in smaller locales like those where many of you on this webinar are based, where we don't see the same level of vibrancy and economic development activity that we do, job growth and so forth that we do in some of the bigger cities around the state and around the nation. There are inducements that are required for developers to go take those risks in markets that are still small and evolving. And one of the most common tools that we see is the TIF, which is an abbreviation for tax increment finance. And it's typically a diversion, or it's in its most simplistic definition. And I suppose we might talk in more detail about this, but in its simplest definition, it's a diversion of the real estate taxes that would typically be paid to the county to go and service instead a bond issue that is designed to induce economic activity and help encourage revitalization of areas that need the incentive. So oftentimes we'll see in the apartment space where the TIF bond is issued to finance the construction of a parking garage, let's say, that is attached to or is wrapped around by the apartment property. And the developer wouldn't be able to otherwise make it viable to deliver the necessary parking, let's say, especially in an urban area, without the incentive from the public sector to go build that garage and deliver the parking spaces. And just from round numbers, parking garages cost anywhere between $20,000 and $30,000 per parking space. So you multiply that by 100 parking spaces or 500 parking spaces, and these are significant numbers that we're talking about that are sunk costs in the development, that there may be some recapture in the form of resident revenue for those parking spaces, but not necessarily, especially in some of the smaller markets where these incentives are not necessarily paid for. The benefit of these incentives that are delivered through, let's say, the parking garage are not necessarily paid for by the resident. In a lot of developments where the parking garage is just not a necessity, There could be many, many other forms of public incentive that are required, such as infrastructure and running street, running utilities, running public facilities that don't exist to a development, or acquiring the ground for the development that wouldn't otherwise pencil without public incentive. So a critical piece of the equation for multifamily, and in particular mixed use development, and I would even say especially so in some of the smaller markets, is the use of public incentive to incentivize. Okay, I'm going to jump into some slides here and we'll talk a little bit about what we're seeing happening on a national level. So this is a very scattered slide, a lot of data here, and I'm not going to even attempt to call out all the markets that you see here, but I will make a point, which is that we've got three different segments of markets as shown on these next three slides. We've got the large markets with apartment unit counts of 90,000 and greater. So you see Indianapolis in the upper left quadrant. Indianapolis is a market with about 165,000 apartment units. And what this table is showing is via COVID, the markets that are performing well and those that are not performing well. And what you'll see along the left-hand side of the screen, the axis that's showing 6 at the top and -15 at the bottom is rent change. So anything above the solid line, about 2/3 of the way up, you'll see 0, the horizontal line. That is 0 rent growth. Anything above the line is obviously is positive rent growth market. Anything below the line is a negative rent growth market. The other axis, if you look along the bottom of the slide, is showing change in vacancy. So we want to obviously be shedding vacancy, not adding to vacancy. Left of the vertical heavy line and near the center of the graph are markets that are shedding vacancy, and to the right are markets that are increasing vacancy. So via COVID, the markets that are performing better are those in the orange circle at the upper left of the table. Those that are performing more poorly are at the bottom right-hand range of the table. So we see very much a tale of two recoveries here inside the COVID crisis in the US in the apartment space. The primary markets, the largest markets, those that had historically been the best performing markets with the highest rent growth, the lowest vacancies, and oftentimes the lowest levels of supply, are now the markets that are really struggling. So you see, I don't know if you can make this out. I know these labels are small, but we've got New York, San Jose, and San Francisco as the worst performing markets from March of 2020 through September of 2020. So the COVID time range. And then the markets that we see performing better are the smaller markets. And that's the point of this story here. We've got the primaries that have become very challenged. They're very urban markets, high density with people on top of each other. And obviously with the crisis upon us here, folks have made the decision in increasing numbers to not live on top of each other, to move out of urban areas, to park in an open lot, to walk into their own front door, not walk through an enclosed corridor with strangers you might pass along the way, or walking into elevators with strangers who could present possible risks in a time of crisis like this. So the smaller markets have actually performed well. And if we can roll to the next slide, we'll take a look at the next size range down. These are markets with 40,000 to 90,000 units. And you see a lot more concentration of better performing markets in the upper left-hand range of the table, as these are smaller markets, typically less urban, markets that had not made the headlines so often in normal times, but in a time of crisis are performing pretty well. If we can roll forward one more slide, we'll go down to even smaller set of markets. So these are the markets with 20,000 to 40,000 units. And you see again the same thing. Many of these markets, the majority of these markets are performing very well through the crisis with rent growth and with tightening levels of occupancy or reduction in vacancy. So for a lot of these markets, and many of you sit in these markets where we don't see not in the headlines, we're not making the national news, and probably won't be making the national news anytime soon. But the point is that the smaller markets are performing well in a crisis. People are wanting to get out of the cities and into a little more open space. And so really, those of us that live in smaller markets, and I'll even call Indianapolis one of those smaller markets on a national scale. It is a smaller market. It's our time to shine. And we'll flip forward one more slide here. One of the things that's critical to doing development, and as lenders putting out capital into multifamily development, is the research side. There are a lot of organizations, a handful of organizations nationally that are doing a very good job at tracking apartment performance throughout the country. Unfortunately, that tracking falls off as the market size diminishes. Indianapolis, for instance, is very well covered by 3 or 4 different data providers. We at CBRE tend to use axiometrics quite often. We've also done our own market research year over year. So my team will conduct surveys on many of the properties throughout the state and many of the larger markets throughout the state on an annual basis. And we've done that for 25, 26 years or more. Axiometrics stops at Bedford and Bloomington. So we'll just talk about those 2 markets. I know it's a bit of a head scratcher how one would get data on some of the smaller markets in the region. And I don't have a good answer for that. I think that it's generally just going to be done the old-fashioned way, like we continue to do it, which is picking up the phone, making survey calls to the properties in the submarkets that are of interest. But for Bedford and Bloomington, interesting to note that both the markets have grown rents on a year-over-year basis at 3%. So a very normal level of rent growth, even though we're in a crisis, which is back to my point earlier that these markets are not falling apart. The wheels are not coming off the bus in our markets. I'm talking about our markets as, let's just say, the state of Indiana and the various apartment markets that comprise the state of Indiana. Things are relatively healthy. In fact, perhaps even better than normal. I have not studied Bedford rent growth levels on an historical basis, but I would argue that 3.15% is probably fairly close to the normal and maybe a bit better. We can scroll forward one more slide, please. Take just a quick look at population growth. Again, we're not setting any national records here in the state, particularly in this region for population growth. But that's okay because we are stable. And the average annual rate of population growth from 1960 to 2010 was 1%. You can take that to the bank. That's going to happen regardless of what's happening in the rest of the world. And we've proven it here over a 50-year period of time. And then you look forward to the 2017 estimates, and we continue to see more growth. Now, when you look at where the capital wants to deploy, where the investment capital, the markets that it wants to be exposed to, many of those dollars get deployed directly to the high growth markets, the boom and bust markets, the Seattles, the San Franciscos, the Bostons, the Austins, the markets where there is tremendous growth, and there's also significant risk to the downside in time of recession. So again, back to my point a few moments ago, those are the markets exactly that are, many of those anyway, that are struggling today. They just don't have the stability feature that we have in the state of Indiana. Next slide, please. So again, back to my point earlier, the preferences between urban and suburban, and here's the data. This is the report that Greystar, which is the largest operator of multifamily property in the nation, Greystar has produced this data. And so what we see is on the left-hand side of the graph, urban data showing rent growth. This is lease over lease, so we call it a trade-out view. One lease expires, lease in that same unit and what's the delta on that transition from old lease to new lease. And what we see is through the crisis, beginning with April in the urban side, negative 1.6% rent growth in April. That number fell to negative 4% rent growth in May, and it's continued to descend, as you see, all the way through July, where this particular study ended. We also see on the suburban side, conversely, that it's been a very different set of outcomes. We're looking at let's look at total leases, blend of both new leases and renewals in the suburban side. I'm on the portion to the right-hand side. In March, we were still growing rents 3.7%, fell in April to 3.5%, and you see the downward trend to 1.8% in May, down through July at 1.2%. So it's declining for sure, but it never falls to the negative on the overall, which is evidence of the preference for some of the market to move out of the downtown areas and into the suburban areas. So the question I think a lot of developers are asking themselves is do we design development for a crisis, or design development for normal times? And I don't think there is a 100% correct answer to that question. I think there are different theories on both sides of the question, but my personal theory is that our memories are short. And once we're back into normal times, post-vaccine and post-social unrest, we see in many markets, we're going to see a return of people back to the urban core, back to an urban setting, for all the reasons that people have moved into the downtowns of America over the last 25 years, proximity to amenities and employment primarily. Okay, next slide. So just I'm going to close on this one. Just another emphasis on what happens in a crisis for the often untold story markets like the Indianapolises of the nation. And Indianapolis, which has hardly been a top 20 market for anything on a national level over the last 20 years, finds itself as the top rent growth market in the nation in the month of July, or sorry, August over August study produced by Yardi. So I think there are a lot of reasons for all of us and all of our markets to be very optimistic about the exodus of COVID and how our markets fare, and how the capital on both the equity side and the debt side looks at our markets very favorably. I'll end there.
Okay, thank you so much, Steve. Really appreciate all that great information. Next, we will have Eric Baird, who's going to talk to us about project financing through traditional lending institutions. So Eric, take it away.
Lisa, thanks for having me participate in this, and I certainly enjoy talking about the world of real estate. Owen County State Bank is I'd say probably an average sized community bank, about $270 million in assets. So, when we're looking at projects, most of the ones we're looking at are they're going to be privately owned. We're not typically going to be looking at national developers and national builders. So we'll sit down with the project owner or developer, and we want to know really three things. Tell us about the project. We want to get to know the owner and developer, and then we like to get to know the contractor as well. Oftentimes the owner and the contractor are one and the same. Sometimes they're not. So if there is a separate contractor, we'll want to have a little bit of a bio and some information on that contractor, what their specialty is as well. So we'll start with the project. What is the project? Why do you want to do the project, and why do you want to do the project now? Obviously, with COVID, it's added several bumps to the economic road, which was looking pretty good before, and I think it still is good. but certainly people are a little more cautious about moving forward. The good thing is, while the economy's pulled back a little bit, if you're doing a construction project, it's going to take some time to complete the construction. So while the workforce isn't back to 100% right now, it's a pretty good time to get a construction loan and do a project. If during normal times that project would be deemed good to develop. Typically, when you do a construction loan, you're going to build an interest reserve in, so you don't need income coming in because you're going to fund the interest from that interest reserve. So if you're doing a 12 to 18 month construction loan, in this case, I would hope that 12 to 18 months, we've got a vaccine and the curve looks a lot different with COVID than it does now. So now's actually a pretty good time for people to start building a project, again, if it makes sense during normal times to do that. So we want to tell us about the project, why now, and then tell us about the team. Is it something that we're going to have one owner, possibly it's multiple owners? I'd like to know their backgrounds as well. Need to see what we call sources and uses, where you give us a list of what the sources of financing are, the cash that's going to come in, who's going to bring in the cash if it's multiple investors. Typically we're looking at on a construction project financing 80% of the cost. So we like to see 20% of that cost coming in as cash from the various owners and investors. So, what are the uses of that money going to be? Buying the land, financing the soft cost, the hard cost, your soft costs being engineering, appraisals, environmentals, permits, surveys, all that, and your hard costs being the concrete, electrical, and all the other items. So that sources and uses will give us an idea of how you're thinking through the project being financed via your own money as well as the bank money. And then we'll want to see, if it's a construction project, specs and plans, and we'll want to see a construction budget as well, which you hopefully by now would have been talking with a contractor, and they would have put together an estimate or a construction budget and the timing of that budget. Because if we're doing a construction loan, we'll want to have an idea of how many draws you intend to make off of that, which is what is typical. A contractor will generally want to file for a draw, apply for a disbursement toward the end of the month so that they can pay their employees by the beginning of the following month. So if it's a 12-month project, on average, I'd say we probably anticipate about 12 draws off of that construction line. So once we get comfortable with the project, why you want to do it now, we'd like to get to know you as the owner as well. Like to see a resume. What's your background in doing this type of project? If you don't have much experience in it, if you have a recurring source of income now, is that going to continue while you're taking on your first project? So anything is possible. Obviously, if we're working with an experienced developer, it's a little easier to underwrite and get through, but we've had people that have done their initial project with us, and enjoy helping get those people started as well. That's one of the beauties of working with a community bank. A lot of times they can look outside the box a little easier than some of the large money center banks. So we like to start off by having you fill out one of our many acronyms, a PFS, which is a personal financial statement. That tells us a lot about where you stand financially. We'll take a look at your assets that you own. We'll take a look at the liabilities, the debt that you owe, and look at what your net worth is and your liquidity. Often on these projects, we like to see that there's an ancillary source of cash flow available, so that if there's a hiccup in the economy, or let's say that the project doesn't lease up quite as quickly, maybe you've got a competitor that has something coming out of the ground as well, and the cash flow may be a little slower getting going than what initially anticipated. We like to know that that owner has got some reserves and have the willingness to come in and help, which leads me into the next piece of information. Typically on these deals, both the construction loan as well as the following permanent loan will want to have guarantees from the owners as well. We'll want to take a look at a property schedule. If it's an experienced developer, they'll typically have multiple projects going on. Some may be stabilized and completed. Others may be in the middle of a construction loan as well. We want to see a schedule that shows what the property is, what the occupancy is, what type of net operating income it's throwing off. If it's not completed yet, what percentage of completion is it at? The property schedule will typically show if there's debt on the property, who the debt's with, what the loan to value is, and that type of thing. So that usually comes along with the personal financial statement, gives us a lot more detail and information on the specific real estate properties that the owner developer owns. We'll also want to see tax returns, personal tax returns, typically 3 years, and we'll want to see K1. So oftentimes owner, like I said, will have multiple properties. If they're prudent, and most of them are, they'll typically have those properties in separate LLCs or S Corps for the protection. And the K1s will show the actual cash that's distributed from those, which is often different than the income or loss might indicate. So that's why banks are pretty strong in that they want to see the K1s in addition to the tax return. So 3 years gives us a good snapshot of kind of where you've been. That way, if you've had a spike year or a down year, if you're looking at a 3-year period, it gives you an overall average snapshot of how that individual's doing. And then, like I said, if the contractor is going to be somebody different, we'll want to have some information on that individual as well. Some background on properties that they've developed, what their specialty is, make sure that they're going to be a good fit for the project. So that gives us a good, once we've gone through all that, it helps us get to know you, why you want to do the project, your team, what their background is, and we're all going to get a good feel if this is a good fit for our bank, and our bank's going to be a good fit for you. Now I'll talk a minute about the process. So once we get the financial information, you've given us your estimate on constructing the project. We'll go ahead and we'll have our credit team do a package where they underwrite. It'll go through an approval process, which in most cases involves our board as well as our loan officers. Once it's approved, a couple things we'll need to do is get an evaluation on the property. So the bank will need to order an appraisal, which brings up another point. I know oftentimes an owner will want to go ahead and order an appraisal themselves. While I think a feasibility study oftentimes is a good thing to do, don't go out and order your own appraisal, because the bank is going to have to order one independent of what you've done. And if you've ordered one, we're going to have to use somebody else, and you're going to have to shell out the same or more money to get that done. And you don't want to double dip. We don't want you to have to bear that expense twice. So best to just hold off on the appraisal until the bank is ready to move forward and order it, which they typically don't do until the deal's been approved. So that way you don't have the risk of coming out of pocket for that appraisal until the deal's done. So typically we get it approved, and then we would bid out an appraisal, which will be a mix of cost and turnaround time. And we'll let you choose what you want to do. Once we get that done, we'll get the appraiser engaged. The other thing that we'll need you to do typically is a phase 1 environmental, make sure that the ground that you're buying doesn't have any existing contaminants, or an adjacent property isn't putting some type of chemical into your property that's not good, that affects the groundwater. There's no underground storage tanks, etc. Once we've done all that, generally the phase 1 and the appraisal get done about the same time, and assuming those come back in satisfactory, you've already got your loan approved. Typically, we're ready to go to documentation. I generally tell people on a commercial real estate loan, the expectation is about a 6 to 8 week turnaround time once we get all the information. Because the appraisals typically take, you want to allow about 30 days. We do have some that are turning around as quickly as a couple of weeks right now. COVID has helped out with that. While residential has been a pretty hot market, single family homes, the multi-family and commercial has been a little bit slower. So the appraisers have had a little bit more time in their hands and can get deals done quicker, although I'm starting to see that slow up just a little bit now. So 6 to 8 weeks from the time we start until the time we are able to get the loan closed is a pretty good rule of thumb in what to expect. If you're doing if you're buying an existing property, obviously there's no construction loan. We would just be looking at the existing project itself. We would typically want to see about 3 years of operating statements on that, which if you're buying the property, the existing owner should have some information that they can provide you via operating statements or tax returns. We'll want to see how the project's done over the past few years. More importantly, with real estate, you want to look forward. What's the demand for apartment units? What's the vacancy look like? Anything new coming up? All that information comes out in the appraisal, but we like to have an idea ahead of time what we think we're going to want to see. So if it's an existing property, we'll want to get that financial information. If it's a new property, obviously the construction loan. Once we get through that, let's say it's a 1.5 year construction period, and then you'll want to give some time for that property to stabilize. So we'll typically do an interest-only construction period. Could be 24 months, give you time to get tenants to come in. And then once that's done, you'll typically want to get a permanent loan, because once it's stabilized, could be the same lender. In our case, we like to do the construction and permanent lending both. Some banks prefer just doing one or the other. You're typically going to get 80% of the cost of the project financing. And then once that's done and the project stabilizes, you can probably get 80% of the value of the project, which is going to be much higher once you've got paying tenants in the building than obviously what it's worth coming out of the ground and being constructed. So once it's had time to stabilize, then you can take a look at refinancing that construction loan and pulling some cash out, which your investors normally are pretty happy about. So that's pretty much the process, what we're looking for. From the owner as far as financials and why they want to do the project, and I guess that'll be the end of my part of it, and I'll be happy to entertain any questions when we get to the end of the seminar.
Thank you, Eric. I really appreciate that. We're gonna move on to Brian now. He's going to talk about financing through CDFI Friendly Bloomington. And then we will do one more poll at the end of Brian's presentation, and then we will do questions. Thank you.
So good morning, everyone. I'm Brian Payne. Thank you for the opportunity to speak, and thank you all for being here. So I'm going to sort of ground us in the financing context. You've heard from a traditional lender, and you've heard from a major commercial investor and realtor. And so I'm a nonprofit that deals with alternative financing. So we're called CDFI Friendly Bloomington, and I'll give you a little bit of background on that acronym and what we do. So first, what is a CDFI? A CDFI is a community development financial institution. So it is a lending entity. It can minimize so I can see here. These are private financial institutions, so they cannot be associated with the government, but they have to be certified by the U.S. Treasury Department. And they can be all types of entities, right? It can be a loan fund, a venture fund, a bank, or a credit union. But their goal is the community development project. So they have to be accountable to a target market that they declare, and that can either be a geographic region or a target population or both. So they can say, we specifically exist to help low-income, low-wealth individuals, minority communities, veterans, or all of those, or a qualified census tract, right? So about half of Monroe County is a qualified census tract with at least 20% poverty rate that is eligible to be a geographic target market for a CDFI. And so they are held to that mission, and they have to submit compliance reports every year in order to verify that they're enacting their community development mission and should stay as CDFI. So besides capital, CDFIs also have to provide development services and technical assistance. So part of the way they get their certification is either in-house or through relationships with partner entities. They have to offer business support services, development assistance, and support along with the capital to the borrower. We talked about the target market, and then the model is generally, these are profitable entities, so they can be either for-profit or nonprofit. They can be depository or non-depository institutions. So they have to be profitable enough to make their bottom line, but they're not profit maximizing entities. So they're accountable to their community and their mission rather than their shareholders exclusively. So these are good entities, and they do really good work in sort of the fringe markets around the for-profit housing market. So what do? Housing is just a portion of what CDFIs do. We'll focus on that today. Nonprofit borrowers are a big market for CDFIs. So nonprofits who need to enhance their capacity, hire staff, build facilities. Certainly affordable housing, and that can be either big tax credit deals or small affordable housing developments by local developers. Childcare, infrastructure, certainly small business and entrepreneurship. There's a consumer side that we don't focus as much on, but credit enhancement, mortgage assistance, certainly. So it's very relevant to the residential housing market. And then it can be commercial real estate and affordable housing. So CDFIs tend to look like, their coverage map tends to look like the power grid, right? So they not only are the markets that they serve, the eligible markets, tend to be clustered in big cities, but so do the population and so does the demand. And so CDFIs are mostly located in larger urban areas. So small markets have a difficulty accessing CDFIs, in part because they don't have enough demand for capital to entice the CDFI to work there. The entry cost of acquiring and developing a deal can be high because you don't have an existing office, or you don't have an existing business development person in the market. You don't have connections in the market. And then the supply of financing from partners can be difficult to manage when you're not in a big urban market. And it's difficult to sustain a market presence when you don't have the sort of large market to choose from that's available in a big city. So it's a reason why it's difficult for places like Bloomington and the other counties in the Regional Opportunity Initiatives region to access the services and capital that CDFIs provide. So I focused a little bit on Bloomington here, but just one of the examples is that this is a city and a region with two major modes, right? There's a huge Indiana University presence, and so there's a couple different cities and types of people, right? A huge student presence here in Bloomington, which creates a highly service-intensive economy and a really high quality of life, right? So that's where you saw in Steve's presentation a high average rent in Bloomington, and it's the highest average rent in Indiana. And so when you combine that with the fact that there's very few large, stable employers that support large quantities of jobs, that means we have a need for economic diversity. And because of our huge student market, we have a need for liquid capital that's not tied up in student living, which is a really boom market these days. And most of all, as I think the ROI housing study has made clear, one of the region's greatest needs in the next few years is going to be affordable workforce housing. So the CDFI friendly model is an unprecedented nonprofit model, and it's basically designed to help get the CDFI industry to work here with the mission of supporting community development projects. So as a nonprofit, what we want is to see a community development project succeed and to make projects happen. And the way we've chosen to orient ourselves to do that is to be proactive and reach out to the CDFI industry with our market opportunities. So you see investors like national banks and big funders at the top. They finance CDFIs, and then typically a CDFI is located in a community and can aggregate deals and lending opportunities itself. We step in place of that because we don't have a CDFI in Bloomington. We don't have one within 45 minutes of here. And there are very few CDFIs that have declared the state of Indiana statewide as their target area. And so our job is to take the local opportunities that CDFIs aren't aware of and other funders aren't aware of and promote them to CDFIs that are a good match, right? So my job is to be sort of a harbor master and learn about what borrowers need funding in the South Central Indiana region and match them with potential lenders in the region and in the nation so that in that sense, we can access the best of the CDFI market without having to start a CDFI onto itself or try to enter an already pretty well-established market with a brand new entity that won't be able to fund all of the needs that we have here in the region. So this is just that same graphic placed in context with other markets. So there's a typical financial market on the left, a CDFI market where the CDFI has a presence. Indianapolis has several CDFIs, for example. And then we're over on the right, just sort of stepping in for the CDFI presence. And our job is to take opportunities from the region, farm those out to CDFIs, and then make sure that we're also representing local interests, right? So our job is to be sort of a representative entity for local needs so that we're doing a good job making sure that CDFIs are helping to serve them. So this is just for context. Before we came into existence, we were certified as a 501c3 in December 2018. Before that, CDFIs made a total of about $5.3 million worth of loans over the better part of 2 decades. So that's just for context. And then we came into existence. So we've been a fully staffed organization for a little over a year now. We serve South Central Indiana. We'll see our region in a little bit. But our founding was based on civic leaders from the Community Foundation of Bloomington, Monroe County, the city of Bloomington, the BUEA and other local leaders getting together and seeing that we had a real need for flexible and affordable financing for some of the typical regional needs. We needed small business support, certainly housing development and nonprofits, and these are really in the wheelhouse of what CDFIs do. So we're fortunate to have a mayor in Bloomington who formerly ran a CDFI in a previous life in Washington, D.C. And we're fortunate to have really, really good partners in the Community Foundation, the Urban Enterprise Association, and at the city to support the creation of this new model. So just a little bit about our structure. We are an independent charitable organization. We serve the Indiana Uplands region. So that's the 11 ROI counties and then 2 more. We have a board of directors with 7 members on it, composed of representatives from the city, our 2 other founding nonprofits, and then 2 members of local banks, 2 local business owners, actually. So we have a pretty good balance of community borrower representation, community advocacy, and then funding expertise. Our funding comes operationally from banks and competitive grants. We're very fortunate to have received a competitive grant from Regional Opportunity Initiatives. And we also have investment capital from local banks. I'm the full-time director, and we're lucky to have a fiscal sponsorship with the Community Foundation, which means I don't have to focus as much on HR and controller issues. I have the Community Foundation and their established structure to help with that. So that's been a really valuable tool for a startup nonprofit organization. So CFP Capital is our enhancement fund. So this is a small pool of capital that was donated to us from the the Urban Enterprise Association and the city of Bloomington. And that is designed to incentivize CDFIs to invest here. So it's owned and operated by our organization. We have an investment committee with our bankers and a commercial realtor and lawyer on it. And they approve the expenditures, and it's designed to either help CDFIs get over, concern about too much risk. If it's a small CDFI and they can't lend enough to make a project work, we can enhance it that way. If a CDFI can't lend at a rate that's affordable to a borrower, we may be able to lend at a lower rate to help manage the risk and help the project actually succeed. So here's our service area map. That's the 11 ROI counties, and I think the different ones are Jackson and Crawford. So basically, when I'm talking to communities or CDFIs, I talk about 4 major services that we can provide. One is what we've talked about, which is the simple identification and development of prospective investment opportunities, right? So aggregating deal opportunities in the region that the CDFI industry wouldn't be aware of, and playing matchmaker. The second one is marketing those prospective opportunities and making sure that I have a good engagement with the major CDFIs that are interested in working here, right? So having that access to CDFIs and helping borrowers get matched up with a good one. We have the enhancement capital at CFB Capital that we just talked about. This is available to borrowers in our entire service area. And we are working on, we've approved one investment opportunity that hasn't closed yet to deploy this capital, and we hope to do more very soon. So we do have money available, and we can either be a co-lender with just one CDFI, or we can be part of a larger capital stack in a bigger commercial development project. And you know, we're valuable in the sense that we're not profit driven. We can provide affordable rates, but also we don't have a lot of restrictions on what we can spend the money on, right? You heard Eric talk about the entire development process, soup to nuts, and we can offer financing to help with that entire process. And then finally, as you heard earlier, CDFIs offer technical assistance coordination. So we not only can we set up potential borrowers with CDFIs to do that, but we can provide that ourselves. I have some experience with city government, certainly a lot of experience with the planning and tax process in the city. And I'm willing to be a third-party advocate and offer assistance, as is our organization and our board of directors, to potential borrowers. So just a quick summary of our impact thus far in about a year. We have 9 participating donors. I think that's about to be up to 10 when we close an agreement soon. We have, if you hearken back to the 2 decades worth of CDFI investment totaling a little over $5 million, in just a year of operation, we've secured over $15.6 million in CDFI capital investment for the region in projects that all told comprise about $28.5 million. We've closed 2 projects that we have supported with CDFIs. We have several applications pending. We're working with a lot of CDFIs, and we've supported 166 affordable units to this point, whether renovated and rehabilitated or new construction. So we talked a little bit about the services we offer. This is just another way of phrasing it to cater to CDFIs, right? So we have the enhancement funding we talked about. We can provide technical assistance and local coordination in our backyard that they may not be able to provide because they don't have a presence here. And then we can aggregate and vet and assist local investment opportunities and local borrowers be ready for the lending process and to be successful throughout the underwriting process. And then the one thing I haven't mentioned so far is number 3, CDFIs that work with us can access 1% or less financing from Bank of America to help backstop their investment. So basically, Bank of America is the nation's largest investor in CDFIs, and they want to see CDFIs expand into small cities and rural markets. And in order to help that happen, they're really interested in this new CDFI-friendly model. And to demonstrate its viability, they're offering CDFIs enhancement investment financing if they work in Southwest Central Indiana. So that's a really strong incentive to a lot of CDFIs to consider working in our counties that they wouldn't otherwise be interested in. So obviously we're going to ignore the third one. I'm not asking for donations today, but you know, you can help by being a part of our network, right? So if we can be most effective as a financial liaison and a matchmaker, we need to know about the projects that need financing and the housing developments and other projects that could use bridge financing, co-lending, any sort of capital. And even if you're not sure if you need capital, you're not sure you might be a good match, I'm really interested in learning about what projects are out there. And then you can be an advocate and an ambassador and make other local and regional leaders aware of this opportunity. I want to have as many conversations as possible to learn about this large service area and our market. And that depends on the hub and spoke model and help from folks like you. So I appreciate your time. And I'm happy to answer further questions throughout our panel. And there's my contact information.
Okay, let's get started with our questions. The first one I'm going to ask of all of you. What are the major financing challenges for small local developers, and what are the best resources for tackling those challenges? Who would like to go first? Don't make me call.
I think one of the challenges in a small emerging market is just quantifying the demand. There's no data set that exists in the market to prove that there is a rental demand at $1.50 a square foot or whatever the threshold is it's necessary to justify the development. So I think that's an obvious challenge. I don't know if that's the greatest challenge, but it's certainly one that needs to be overcome. And that's where a good market study comes into play, I think. And Eric would probably say, yeah, we like the market study, especially for somebody who's doing a pioneering type development.
Eric, do you have something to add?
I would agree with what Steve just said. And to go one step further, the obvious COVID-19 has, I know we're all sick of hearing about it, but that's probably been one of the biggest challenges, I think, because we were looking at doing a hotel recently, and good brand, I think a good location, really good developer, and hard to find a participant bank to go in on it. And the main reason, not just because they did or didn't want to do a hotel, but because of COVID. Our outlook was, yeah, but you got a construction period that's quite some time, and COVID should be over before the project gets done. So I think that probably has caused a lot of banks to, that's probably the biggest challenge, in addition to what Steve was saying before, just being able to prove that the market will accept the project. Feasibility study will do that. Obviously, when we get the appraisal going, that should uncover demand as well. At that point, you got to put some money into it, but that's part of the cost of doing the business.
Brian, what are you seeing? What are people coming to you for with regard to financing challenges?
Yeah, it's a good question. And the term small local developer could mean a lot of things, but often it means a developer with, less capital backing than a larger one. And often it means one with less experience. And so it's, they don't have affiliated partners necessarily. They don't have an architect in-house. They might not have a marketing team in-house, and they haven't been through the planning process as frequently as an experienced developer. And so one of the biggest challenges that I see from potential borrowers from CDFI friendly Bloomington is a lack of experience and a lack of resources to respond to all of the procedural hurdles that you have to overcome to get both financing and to get your project approved publicly, and to finance it and make it successful.
Okay, well, that actually segues really nicely into this next question. During community discussions about development, some people expressed skepticism that we really need more housing. So what are the most reliable sources for confirming vacancy rates and housing demand? I'll open that up to anybody.
As I mentioned earlier, I think that's the challenge. The smaller markets are just not researched. Indianapolis was one of the later markets on let's just say a top 40 markets nationally basis to get picked up, just because it's a smaller secondary market. Even more the case in some of these smaller towns. So that's where, to Eric's point, I think an appraisal, a market study where somebody's actually picking up the phone and calling properties is probably the most reliable and maybe the only way to get market data in some of the smaller towns around the state.
Eric, you're nodding. Do you have suggestions on places that they could go for data or things they can do that would be acceptable to your bank?
Sometimes the appraisers aren't usually going to give you much information free of charge. You know what? I would say the commercial brokers with some of the realty companies. I know when I'm in Columbus, I've got one gal in particular that I've always gone to if I've had a question about something. And commercial brokers are very open. They love to share the information. take them out, buy them lunch, and you'll probably get all the information that you want, at least enough to get you started and have an idea of what you're going to run up against. Anything above and beyond that, you're probably going to have to show up some dollars for.
Well, I'm going to combine a couple questions with that one, but are there any financing options for WBE small business startup developers? So women or
I can jump in on that one. The one thing I would say is WEs is one of the eligible populations that can get a CDFI certified with Treasury, right? So there are community development funding organizations that are interested specifically in working with women-owned business entities. So that makes you a smaller pool to compete with other folks for financing to start with.
All right, I'm going to combine a couple questions here. We have one that says, I know TIF, utilities, and land were discussed as means of a local government helping to incentivize housing. Are there any other creative approaches that you've experienced? And I want to tack onto that because you've talked about incentives. What are you seeing? What are the most common incentives used? And how do you approach, or how would you suggest that developers approach communities to ask for these incentives?
I'll let others speak to the mechanics of it, but the other program we didn't really discuss is simply the affordable housing piece of the equation. And that's Section 42 typically is what that means. And whether it's part of Section 42 or not, cities are increasingly wanting to see some sort of affordability component added to their developments in order to agree to incentivize them at a public level. So oftentimes what that means is that some percentage, 5% or 10% of the resident profile will meet certain affordability restrictions, and the rest of the property is market rate. So we've got mixed income, and we see this all the time in the big cities where you've got high income next to low income in Chicago or New York City or other major metros. And it's just a little bit more of a foreign concept here, but it's evolving and catching on in many of the markets. And we've seen that in Bloomington and several other cities around the state. Brian or Eric can probably speak to the mechanics of how you access those incentive dollars better than I could.
Ryan, I'm going to pick on you since I know you used to work at the city. So how would people go about asking for incentives?
No, it's a great question. So for Bloomington in particular, I can't speak for other communities, but Bloomington has a tax abatement process and has created an affordable housing development fund to help incentivize affordable housing. So that those are two separate processes. And I would say that the way to get started with that process is to speak to the Department of Economic and Sustainable Development. So I think Alex Crowley was on this call. I'm not going to call him out and make him answer questions here, but he's the director, and they handle both the disposition of the Housing Development Fund, which is a separate pool specifically to help support affordability components in development deals or affordable developments. And that department's also responsible for the tax abatement process. So if you're interested in a tax abatement, as Steve described, that process is housed in that city department too. The other thing I would say is, the state and obviously the Department of Housing and Urban Development offers low-income housing tax credits. That's a very competitive market. So if you're interested in going down that route, there's a lot of developers who focus only on LIHTC and only on tax credit projects, and CDFIs do that too. I'm happy to talk about that and connect you with folks who can do that. But there's a lot of money there, but it's also very competitive.
In communities other than Bloomington, my experience has been that the redevelopment directors or head of the redevelopment commission, or they will sometimes have economic development directors, is a good starting point for accessing incentives through local government. So we already talked about that. Eric, you had mentioned about asking for a resume. So if you have a resume that is a little light in development, how do you overcome that challenge? Can you partner with somebody? I mean, what kind of experience can you show that would be acceptable?
Well, and that was going to be my suggestion. You'll often see a team, could be 2, 3, 4 investors, owners of an LLC. And, one person may not have a lot of experience. They may be the brainchild. Maybe they've got capital. They've got something that's going to add value, and then they'll bring on somebody else maybe that doesn't have so much capital, but they've got experience. Could be on the construction side, could be on the development side. But I've seen a lot of times where you pool resources to overcome the deficits, and when you've got a team put together, it all averages out to a pretty nice, solid guarantor / owner. That would be my suggestion.
I'm going to ask you one more question before we move on. You had talked about looking for the investment from the owner itself. So if you're a new developer and you don't necessarily have a substantial portfolio, can you use the incentives that you might be able to access through local units as part of that investment? How would you overcome that need?
So the owner doesn't have a lot of cash to bring into the deal, say to put 20% in. There again, I probably would go back to what I was just talking about and pool some other investors. And SBA is not going to be a player in this, but I know there's probably other government entities out there where you've got some support and guarantees that can help out with. But I think having a pool of talent when you've got an owner investor that doesn't have a lot of experience and or cash, just pulling some resources to bring that in would be my suggestion.
So I have a couple of other interesting questions here, and I'd love to get your take on it, all of you. So I think that this is probably going to be more in Steve's area, though. Bloomington has seen several large student apartment developments in the last decade. Does available financing drive trends like this, or are they fueled primarily by market demand?
Well, I think they're probably related at some level. However, it's absolutely market demand that's fueled the evolution that we've seen in the apartment space over the last 20 years. I mean, it's transformed. It is nothing like it was 20 years ago. It's luxury housing now for students. These are kids who increasingly grew up in their own bedroom, maybe even had their own bathroom, and they want the same thing when they go off to college. So the conditions that many of us lived in while we were in college, even at IU specifically, bear very little resemblance to what's available today, and the market's willing to pay for this housing that is, by any definition, luxury housing.
So we know that we have a housing inventory shortage, and we see that in our single family market too. So if market demand is driving some of this, how do we get market demand for single family housing? Because we know it exists to help spur development in that area. Any suggestions?
I guess a clarifying question back to you, Lisa. Are you suggesting that is an initiative to
Well, I mean,
single family?
I guess my question was based on this one is if market demand is fueling these student developments in Bloomington, and we know we have a market demand for single family housing, how do we get that to spur development? Any suggestions?
How do you get single family to spur development for apartments?
No, I'm sorry, I am not asking my question very well. If we know that there's a demand for single family housing, we know that we have an inventory shortage, and we know that people are out there looking for housing even through COVID, but we're not seeing a lot of development in the single family market. And if there is demand there, how do we utilize that demand to spur that development?
Well, and I'll just use Ellisville as an example. I'm seeing quite a bit of development in Ellisville. I see builders doing spec homes that turn into pre-sales before they get halfway done. So, which is a little more affordable area probably than Bloomington. So I'm actually seeing, a fair amount of that in certain pockets.
Okay, I'm getting questions on my cell phone too. So we have this 11 county housing study. So how would you recommend communities use the housing study to gain interest from investors and developers to help gain investment in these communities? Can they use the housing study that shows the market demand to help their application for financing in single family development, I guess?
Yeah, I think they certainly can. You know, as I was during my part of it, I was saying, you know, the what, the why, and the why now. And that certainly can help support the why and maybe the why now. Again, in the end, the appraisal is going to kind of be the equalizer. It's going to come out and show that the demand is there. You know, absorption, how long is it going to take to fill the project? But from the get-go, I mean, a bank wants to know before it makes the loan, has a pretty good idea that there's going to be a demand, and that information certainly can help, short of putting the money into a feasibility study.
I think the smart capital wants to solve inefficiencies, because inefficiencies are where people make money. Inefficiencies shouldn't exist in good markets, in healthy markets. They don't exist. So looking at the study and identifying, let's say, unit styles, maybe the one bedroom in Ellisville grew 5% over the last 12 months. I mean, that's an inefficiency. That means that there's a shortage of one bedrooms in Ellisville. And I'm just making this up because I don't think that's the case in Ellisville necessarily. But the point is to find pressure points in the market and then go solve those. If a market is 97% occupied in the apartment space, that's an inefficiency. I would argue it shouldn't be 97%, it should be 95%, because if it's 95%, you're putting enough upward pressure on rent growth to maximize rent growth and keep a healthy level of vacancy, such as 5%, in place.
The one thing I would add about the ROI housing study is, you know, our other panelists have done a good job answering how the ROI housing study can be used to justify, you know, making a good loan and something being a good investment. And the third component of getting a development project, you know, approved and successful is taking it through the public process. So you can also use the housing study to support an argument that your project meets a community need, right? So there's, if it's an inefficiency and a area of demand, if it's single family or affordability, whatever it might be, if it's something community doesn't have and can use, then that's a useful resource for that part of the project too.
So I'm going to ask you the last question, Brian. What feedback are you getting from CDFIs, and what reasons do they give for not having invested in this region?
Yeah, it's a good question. I mean, the main reason is that we have 140,000+ some folks in Monroe County. Every other county in our region has fewer than that. Most have fewer than 100,000. And most CDFIs depend on a market of at least 400,000 people simply to keep their model going, right? So direct lender servicing model requires a much bigger market. And that's really the simplest answer for almost every CDFI, is that we don't have enough market demand to support what they do. And CDFIs are increasingly specialized, right? So a CDFI doesn't do the whole gamut of CDFI financing. They'll do tax credit affordable housing, or they'll do small business microloans. And so we have a much smaller fragment of each component portion of what CDFIs fund as a group. And that's the major reason why they're not here. But the other reason is sort of, whether you want to call it chicken or the egg, is there's not enough of a market here, which means they don't have a presence, and they don't invest because they don't have a presence. The CDFI model is an alternative one where they have to have better knowledge, more appetite for risk, and a better understanding of the community that they're investing in. And since they don't have a presence, they can't do that. And I guess that's precisely the problem that our organization is trying to tackle.
Thank you. All right, so let's get the results of our first poll. All right, so we had a pretty familiar participant base today. About 50% of them say that they're familiar with the financing process, but 40% are not familiar at all. So I want to thank you greatly for helping us bring some information to our participants today. Thank you again, Eric and Steve and Brian, for sharing all of your information and wisdom with us. And I want to remind you that we have one more session next week, and it's going to be on housing quality. If you are not registered, please go online and get registered. It promises to be a very interesting topic of conversation. So again, thank you for being with us this morning. Thank you to all of our participants. Thank you very much for our panelists this morning. I greatly appreciate your willingness to be here with us today. So with that, we will hopefully see you all next week. Thank you.
Thank you, Lisa.
You.